for attending. We're gonna work through some of the basics, both the background and technical parts of the GILTI tax, and we'll switch to the slides now, and I'll go through some background. We had an even higher turnout than we expected. So we've got both tax experts and people just interested in what the GILTI tax is, and I think it's kind of important to go through the historical background associated with the GILTI tax so that you can get a flavor for why it even came about. The U.S. principally, both on the estate and on the income tax side, is a worldwide taxing jurisdiction. What that means is if you're a U.S. resident, you can be a U.S. resident for income tax, estate tax. There are different standards. In either case, you're going to be taxed worldwide as a U.S. citizen or resident on income or estate if you're a U.S. resident or citizen. So even if you make money on the income tax side in another country, the U.S. will tax you on that money. You will then be entitled to a credit against your U.S. Income tax for any tax you pay in the foreign country. That's true both on the income estate. There also are treaties that alter that, mostly to the advantage of the U.S. taxpayer. But the idea is it's this worldwide taxation. Most countries actually are what's called a territorial base, and they use a territorial system whereby, for instance, with respect to the income tax, which is what we're dealing with today on the GILTI tax, they only tax you if you make money associated with the country, either in the country or related to the country. You're subject to income tax in that country. Otherwise, if you make money, even if you're a citizen and you make money in another country, they don't tax the money. It's much more limited. It's also much more simple, by the way, for the administration of the tax than having to tax all the income people make on earth and then credit them for income tax they pay in other countries. So one exception, more territorial than international, worldwide taxation base, is if a U.S. individual owns stock in a foreign corporation. The foreign corporation doesn't cause the U.S. individual to incur tax until dividends come back over. So if you got interest in a foreign corporation, you pay tax when you receive dividends on it. In the 60s, that was subject to some abuse. So what happened, and we dealt with the same regime for, I guess, 50 years, 55 years, whereby the CFC rules were implemented, this controlled foreign corporation. So if you had more than 50% of a foreign corporation and you weren't active with all the money, you didn't reinvest it in the operations, you were taxed on it whether you brought it back or not. So if you had passive income, they call it subpart F income, and you were a CFC, you or your group own more than 50% of the entity, you got taxed on that subpart F passive income. And so the game became, okay, let's find a foreign jurisdiction. A U.S. entity would find a foreign jurisdiction to say, let's go in and create a manufacturing subsidiary. Where are we going to create it? Let's create it in a low tax jurisdiction. Low tax meaning if the U.S. taxes at 35%, Ireland taxes at 11%. Let's do something in Ireland. And as long as we operate in Ireland and keep investing in the active production of income, no tax until money is repatriated. This went on for years and years, and there's all kinds of strategies and sandwiches and treaty benefits and using different jurisdictions, because many jurisdictions allow residency, quote, residency for corporate purposes, even though you don't have to be there all the time, but the tax is very low, and you're kind of offsetting these different jurisdictions against each other. in kind of a strategy to eliminate subpart F income and reduce this foreign operation tax level down. So you're deferring US income tax as long as you can do that. In many cases, it was, decades. And so what happened was you got even into the idea of you could have an excess foreign tax credit where you didn't use up all the credit you had earned that year in operations abroad, and you don't get a credit. You basically, your credit's minimal if you don't pay any tax in a foreign jurisdiction. So if you're paying 11% in Ireland and you're paying 47% in France, and you end up with a little bit of an excess credit, you actually can use the excess credit to just eliminate any tax once the money comes back over from Ireland. It was a really interesting and really almost software driven strategy for many years, and it did promote business abroad. It created a lot of offshore subsidiaries, and the reality was that it created a huge political opportunity that wasn't taken advantage of really until the Trump administration got into office. Realized there's trillions of these dollars floating offshore. How do we get them back in, plug them into the US economy directly? Let's eliminate the motivation to avoid tax in another jurisdiction. So let's create a minimum tax rate that no matter where you go, you have to pay it, even if you don't repatriate the funds. Let's eliminate the motivation to keep the tax abroad and to go to these low tax jurisdictions. So it encourages repatriation, right? And then on top of that, the Trump administration implemented through legislation the idea of, okay, we know this is going to be a huge tax hit when you return the funds to the US. We're going to give you a deduction as well. So a huge amount of money came back into the States. Now you're looking at huge additional spending with respect to what's happened with the country. And so you're going to have a potentially even higher minimum tax rate. That's this GILTI tax. An attorney at the firm said it's not a guilty pleasure. I thought that was hilarious. Anyway, it's this minimum rate so that you can't go to a foreign jurisdiction, trap all the income abroad, forget about it while you keep reinvesting in it, and defer the tax. So you're going to have a minimum rate. And then Paige, who's become the GILTI guru at our firm, is going to now work through some of the details and examples associated with the application of the GILTI tax.
Okay. Well, thanks, Gary, for that great introduction. So the agenda for today, like Gary had mentioned, we'll go through some high-level GILTI information, as well as a high-level overview of the GILTI inclusion calculation. Then we'll talk about who is considered a controlled foreign corporation, and then along with who is considered a US shareholder of the foreign controlled corporation. And then we'll talk about a potential way to limit the GILTI exposure for individuals who are considered US shareholders with the Section 962 election. And then also, there's also been some proposed changes to the GILTI regime, which may or may not come into play. So we'll discuss those as well. Okay, so just a little bit further background about the GILTI. As Gary mentioned, the Tax Cuts and Jobs Act was the one that actually introduced the GILTI tax. It lowered the overall corporate tax rate from 35% to 21%, but it also then introduced this GILTI regime that we're discussing today. So GILTI is essentially an additional category of income that's going to be taxed to persons who are US shareholders of CFCs. And this is, like Gary had mentioned, even if the income is not distributed. So you will be, or US shareholders will be subject to a minimum tax between the 10.5% and potentially 13.125%. And this is annually, so each year you will be subject to potentially the GILTI tax. And these new GILTI rules can be found in section 951A of the Internal Revenue Code. Okay, so the GILTI inclusion calculation, it's essentially you look at the net CFC tested income and subtract the net deemed tangible income return. So these two terms are important and they are defined terms that have to be further explored. So to determine the net CFC tested income, you look at the excess of the US shareholders pro rata share of the CFC tested income and subtract the CFC tested loss. Now, it's important to note that the GILTI inclusion is calculated at the US shareholder level. So you're going to look at the pro rata share for each US shareholder when making this calculation. So the tested income of a CFC is the entity's gross income, but it excludes several categories of income, such as subpart F income, dividends received from a related person, any foreign oil and gas extraction income, and income excluded from subpart F because of the high tax exception has been elected. So you're going to exclude all of that from the gross income and then also exclude any deductions that are allocable to the gross income as well to come up with the CFC's tested income. Now, the second part of that equation, the net deemed tangible income return, that's calculated by looking at 10% of the shareholders' pro rata share of the qualified business asset investment of each CFC. So what that means is the qualified business asset investment is essentially determined by looking at the average of the adjusted US tax basis in specified tangible property that is used in that CFC's trader business. So it's 10% of that QBAI to determine the net deemed tangible income return. And so once you're able to figure out those two numbers for the specific US shareholder, that would become the GILTI inclusion amount. And so it's also important to keep in mind that each person who is a US shareholder of the CFC, it's only for those US shareholders who own stock in the CFC directly or indirectly is subject to the GILTI tax. And then as we'll talk about in just a minute, determining a CFC also takes into constructive stock ownership, which isn't taken into account to determine a shareholder's GILTI inclusion amount. So that's kind of the high level roadmap of the GILTI inclusion calculation. So now, as we had mentioned, only US shareholders who own stock in controlled foreign corporations are subject to GILTI. So one of the first steps is to determine whether the foreign corporation actually qualifies as a CFC. So CFCs are defined in section 957 of the Internal Revenue Code. And essentially, if a foreign corporation is owned by more than 50% vote or value of the stock by US shareholders, then the foreign corporation is considered a CFC. Now, it's important to determine who are US shareholders. So a US shareholder is a United States person who can own directly, indirectly, or constructively 10% or more of the vote or value of all classes of stock.
Yeah, so this is a major, I mean, this is not a new idea. So before, remember, you were still taxed on the passive side, whether it was distributed or not. And sometimes, well, the accountants and the corporate lawyers, tax lawyers on the call, the webinar really, would understand. Occasionally we find these foreign entities, everyone's got 9%. You don't count. You don't count as part of the CFC calculation. You know, a number of times you'll be involved in a transaction where, you know, we do an airline or you do one of these major institutions in Holland or usually Northern European for whatever reason. And the US side will be 49.5%. And there's all kinds of stopgap provisions to prevent anyone from thinking that value or voting would be greater than 50% by the US side. And it's due to these provisions. So none of this comes, what happens is neither the subpart F nor the GILTI even comes into play if you don't have a CFC. So the first step a lot of times is just to avoid the whole thing. If it works for the business deal, for the American side to have less than 50%.
Right. And it's very important to understand and to determine if you have a CFC, and additionally whether the individual owners are US shareholders, because it would change things. And so just wanted to mention also that the United States person is also not only a citizen or resident of the United States, but this also includes domestic partnerships, domestic corporations, estates, and then certain trusts as well in that definition. Okay, so to determine whether or not someone's a US shareholder, you look to determining the stock ownership of that foreign corporation. So this would be in section 958 of the Internal Revenue Code. You have direct ownership, indirect ownership, and then also constructive ownership. So I'm going to move to indirect ownership. So indirect ownership applies to foreign corporations, foreign partnerships, foreign trusts. So this is if a foreign corporation essentially owns stock directly or indirectly in another foreign entity. That stock is considered to be owned by the shareholders, the partners, the grantors, etc., proportionately. So that would be indirect ownership through technically a foreign corporation, a foreign partnership.
It's a proportionate, and we've got some excruciating examples, but it's very tightly regulated. So Paige will work through those.
Right, and then also because this rule only applies to the foreign entity, that first US person or corporation or partnership, that's where the attribution would stop. So you wouldn't keep going down the chain if you had multiple US owners in the chain. Okay, so we'll talk through this example here. So we have domestic corporation M that owns 75% of one class of stock, and foreign corporation R. R in turn owns 80% of one class of stock in S, and S in turn owns 90% of one class of stock in foreign corporation T. So essentially you go down the chain and then to figure out the ownership percentages. And so our corporation would be considered as owning 80% of the 90% of the stock which S corporation owns in T, or 72%, multiplying the 0.8 times 0.9. Corporation M is considered as owning 75% of such 72% stock, or 54%. And so since M corporation is the first domestic corporation in this chain of ownership, that's where the attribution stops. So you wouldn't continue to look down that line as the example states if it's owned by another domestic corporation. So that's one example of the indirect ownership. And then here, these two examples refer to actual persons or individuals that own stock. And this is similar to that the first example that we went through, where you really need to look down the chain of ownership to figure out the indirect percentage that would be attributed to the United States persons. So just in the interest of time, we'll look at example 3. Here, United States person C is a 60% partner in a foreign partnership X, and then partnership X owns 40% of one class of stock in foreign corporation Q. Corporation Q is a 50% partner in foreign partnership Y, and partnership Y owns 100% of foreign corporation R. So C, the United States person, is considered to own 12% of that foreign corporation R. And you attribute that through each of the ownership percentages in that chain of ownership to that United States person. Okay.
We actually had a complicated attribution project with the foreign partnership. Why don't you give a little background on that?
Sure. We actually just worked on for a client who was determining whether or not to insert a foreign partnership that would then own a foreign corporation, and he would own the foreign partnership. So we had to look at the indirect ownership rules to determine whether or not he would be considered essentially a US shareholder, and then potentially looking at a way to limit his exposure to GILTI, which one option was through the Section 962 election, which we'll talk
Mhm.
about in just a few minutes. So we had to look at that chain of ownership through the indirect ownership rules. So another way that ownership can be attributed to determine CFCs and US shareholders is constructive ownership. And through constructive ownership, you can have family attribution. So with family attribution, this is where an individual can be considered to own the stock that's owned directly or indirectly by his spouse, children, grandchildren, and parents. Now, it's important to note that there's no attribution between siblings, and there's also no attribution for any stock that's owned by non-resident alien individuals. So it's just spouse, children, grandchildren, and parents.
Do we have a question there?
We do. What someone had asked, what if it is an S corp?
I think what they mean, yeah, if it's an S corp in the States, that's an owner, that'd be your US
Correct.
shareholder. You cannot
Correct.
have an S corp for an S corp. You cannot make an S election on a foreign entity.
Correct. Yep. Okay. And then for this example, for the family attribution, we have a United States citizen E who owns 15% of one class of stock in foreign corporation Y. E's spouse F also owns 5% of such stock. And so E and F have 4 non-resident alien grandchildren who each own 20% of the stock in Y. So E essentially is attributed F's stock in the corporation. However, he is not attributed the grandchildren's stock because the grandchildren are non-resident aliens. So it would only be spousal attribution in this example. Okay, and then we have one more family attribution example where H, an individual H, his wife, his son, and his grandson all own the 100 outstanding shares of stock in a corporation. They each own 25 shares. H, W, and S are each considered as owning 100 shares of C through the family attribution due to spousal, children, and grandchildren attribution. G, as the grandchild, only owns 50 shares in this corporation because there's no attribution to his grandparents. It's only from grandchildren. And so another way attribution works is through partnerships, estates, and corporations. Stock owned by a partnership or estate can be attributed as owned proportionately by its partners or beneficiaries. So it attributes up to the partners. And then the corporations, this has a percentage threshold issue. It has to be 10% or more that's owned by in the value of the stock for it to be attributed to the owners. And then if a corporation, partnership, or estate, if it owns 50% or more of the total voting power, it's considered as owning all the stock entitled to vote. Okay, and so now we'll just briefly talk about potentially limiting exposure for an individual who is the United States shareholder. So Section 962 allows a United States shareholder who is an individual to make an annual election to be taxed as a domestic corporation rather than at its individual tax rates on certain amounts included in the individual's gross income. And this includes the GILTI tax. So rather than keeping the tax rates high, it's a way for the individual to potentially lower the tax.
You can lower the
rates.
GILTI tax.
Correct.
Is there any limitation to that?
You have to be, well, it's at the individual level. So you would have to kind of go through the stock ownership procedures that we just went through to make sure that everything fits. But if you determine if the entity is a CFC, then it's essentially the same calculation to explain the individual as well. So like I mentioned, the election cannot be made by an entity and it can't be made by a partnership. So you have to look at the individual partners to be able to determine if they are able to make the Section 962 election. And the Section 962 election, it can create a tax savings, like we had mentioned, on anything included in the Section 951 and 951A income. Okay, so just more specifically, so the individual can be taxed as a USC corporation. The individual can also claim the Section 250 deduction with respect to the GILTI, so to bring down that GILTI tax to 10.5%. And it also allows the individual to claim a foreign tax credit for any foreign corporate income tax paid by the CFC. I just wanted to note here that it's going to depend on the specific facts and circumstances of each individual to whether or not the Section 962 election will be beneficial or should be taken for that individual tax holder. So all the facts need to be taken into account. Okay. And then also we have lastly some proposed changes. So President Biden in his Made in America tax plan proposed certain changes to the GILTI regime. And he has proposed to raise the GILTI tax to a tax rate of 21%. It's thought that the GILTI tax rate would be raised by essentially reducing the Section 250 deduction. So that would increase the GILTI tax rate as he's also proposing to raise the corporate income tax rate to 28%. And lastly, the GILTI tax, rather than being an aggregate of the CFC's total income, the GILTI tax would be taxed on a country by country basis.
Which is very significant. So if you, for instance, have excess foreign tax credit, or you can manipulate the GILTI from one country to another, taking only that country into consideration, you can usually utilize one country's credits or tax against another's. If you eliminate that, it eliminates a lot of the planning.
Yep. Okay. And then that was it for our intro to the GILTI tax for today.
If you have any questions, we've put up our contact information. We welcome any calls, and our email is there as well. Anything you need, we can get to you. We can also get you. I've written a book on international taxation. We can forward that to you. Also, a book on asset protection. We'd be happy to send you. We really try to be a resource for all financial and accounting professionals. And that's all we have for you today. I hope that was helpful. I mean, we know it was kind of a summary into a very complicated area, but it's become so prevalent in US business today that we figure we'd do a webinar for you. And that will wrap us up. You have a great day, and we look forward to seeing you at the next webinar.